started.
Okay.
Oh, good morning. It is such a good day. So we've got good news to share again as soon as we get over to the second half of the presentation and talk about the economics. But wanted to talk a little bit, well, we'll start with a quote as we get started. Or is it?
It's going.
Okay,
It's
good.
going. Just setting it up on Facebook Live.
Fantastic. All right, here we go. So we just had one of those Facebook Live messages, so it tripped me up. So my apologies. But it is such a good day. PCE came out this morning. We also had a number of other reports, some mixed messages, creating an opportunity in the market that everyone needs to know about. We've also been seeing mortgage purchase applications increasing. All of these things are the things that we're going to talk about in the back half, as well as strengths of the housing market. And I know that Megan's got a ton to talk about in the first half. I mean, guys, this is the time where we have to focus on education and we have to focus on being supportive to our clients wherever they are. And so that's where my quote came from this morning, is supporting those clients that are being receptive, that want to partner with you. If not now, then plan for 2023, versus beating your head against the wall with the clients that don't want to listen, that simply operate out of fear. So Coco Chanel said it best. She said, don't spend time beating on a wall, hoping to transform it to a door. If it's not a door and it's not going to let you in, then move on. But focus on the people that want to be your partner. Focus on creating the A team around you and continue to educate and put yourself in a position of not authority, but consultative, right? To be that guide for your clients. Well, Miss Megan, what is going on?
Well, as you know, Thanksgiving week is one of our slowest weeks of the year, and this year it proved not to be any different than what we've seen in years past. We ended up seeing a big decline in showing activity, and so if you were a buyer last week, you had a great opportunity to get out there with a lot less competition in the marketplace. And so I hope that you took advantage of it, but the numbers get a little bit wonky when I go through and I look at the numbers for Thanksgiving, because everything shoots up and everything kind of deteriorates, and it creates this little soft market spot for about a week period of time where things tend to spring back. And so we had some good activity the weekend before Thanksgiving, and hopefully we'll have some good activity the weekend after Thanksgiving. The good news is that we're starting to see that purge of expired and withdrawn transactions, which drives our inventory down and stabilizes our market into November and December. And so we've been watching our average sales price decline now for about 5 months in a row, trying to get affordability back under control after the huge spring run up in our marketplace. Prices continue to drop, but they're not dropping at quite the same rate as what we had seen previously. So that's a good thing that we're starting to see some of that. Buyers still have really strong negotiating power.
They do.
And so it's a great time for you as a buyer to get out there and to get some of those items remedied from your inspection list, where you can get your properties under contract and hopefully get some of those things fixed. But let's go ahead and hop into some of the numbers.
And going into this weekend, buyers also have lower interest rates.
Oh, that's so
I'll be showing
great.
you that. Yes.
That's so great. Screen one. Your screens are backwards.
Are my screens backwards? Technologies.
I hope I'm showing the right thing. If I'm not, please let us know. And so looking at this data, I did send out a report last week for you to cover the weekend before Thanksgiving. So you should have gotten a copy of that. Even though we didn't have our webinar, everyone got a copy of it. Did you know that we have over 1,100 people on this call today?
I know, only because you told me last night.
I looked at the roster for the number of people that is registered for today's class. 1,100 people, and then we end up getting about 500 more views on Facebook each time. So we've got around 1,600 people that are consuming this information on a weekly basis, and I am just humbled by those numbers.
I am too.
And I'm so thrilled that you guys are joining us on a weekly basis to get this updated information. My distribution list is now about 6,000 agents that are getting this information on a weekly basis with a 75% open ratio. So it is outstanding.
So let's just double click on that for a second though. So if you know that 1,100 people are watching, and you know that 500 more people will watch, and what did you just say, 6,000 agents
6,000
on the distribution list, and I know that we have almost the same in our distribution list, then I'm going to tell you right now, just hearing this information doesn't make you stand out. It's what you do with the information.
Mhm.
Do you use it to then educate your clients? Do you enlist Megan and I to back you, right? To have that A team and the partners that you know is speaking the same language
Mhm.
and backing what you're trying to convey. So it means that you have to work a little harder to not only listen, but to adapt and incorporate the information into the way you're either doing
Mhm.
business or the way you're messaging your clients.
Well, and this is just such a great, easy report where you can cut out
Yes.
just your price range and send that off to your buyers and sellers each week so that they have their weekly market update
Yes.
as to what's happening in their particular price range, and to interpret this information and to give them a 1-paragraph synopsis of what's been happening in the market. You can forward along my email that I send to you guys so that your clients have all of this information. And it's just quick sound bites of information that you can convey as to what's happening in the marketplace. But let's look at what happened over
Yes.
Thanksgiving week. I've got this and I don't know how to make that go away. But
Yes.
Okay.
Yeah.
Oh, no.
No.
No,
Starting.
no. Okay. So we're looking at our heat map for 2022 here.
Just click it again.
And for 2022 here. And you know that we've gone through a cooling trend, but this last week, our cooling trend really settled in and people really take off that time for Thanksgiving weekend. And so we end up seeing that a lot of people end up not going out and looking at homes as they spend time with their families over those holidays. But this has by far become our most blue row in all of the in the entire year so far in 2022. And so we've seen a big decline in market activity over Thanksgiving week, which is why you don't list over Thanksgiving week if you can avoid it. Oftentimes, if you do have to list, it's unavoidable at that point, but you really want to try and avoid listing your properties over Thanksgiving weekend because of this big decline in activity in our marketplace. We did see that our month supply of inventory shot up to 3 months worth of inventory, and that's in light of our buyer activity declining so much over the last weekend. We saw our pending transaction count drop by 35.9% over Thanksgiving weekend. So our buyer pool really deteriorates over that Thanksgiving weekend. And so we only put 489 units under contract this last week. And so our daily average active count came down by 5.1%. So there's that initial purge of expired and withdrawn transactions. And so we're seeing fewer new listings make their way to market as well. Over Thanksgiving week, we only put up 294 total new units across the entire Metro Denver area, which was a decline of about 53% over where we would typically be. Now, as you can see, if you look back here, since we missed you last week, our month supply of inventory actually dropped from 2.2 months worth of inventory down to 2 months worth of inventory just the week before Thanksgiving. And so when we have these 3-day or 4-day holiday weekends, also this is going to happen around Christmas time. There's a pop of activity the weekend before and the weekend after. And so if you do need to make a price reduction, the weekend after Thanksgiving is when you want to try and make one, because there's going to be that pop of activity that happens in our marketplace where you'll get more of that energy generated going through your properties and getting listed. The odds of selling over Thanksgiving week, it actually fell off my graph. I should have rescaled that one for you, but it dropped from 46.3% just the week before down to 36.7% odds of selling over Thanksgiving week. So it represented a nearly 10% decline in the odds of selling had you listed over Thanksgiving week. Now, again, that number should pop back up this next week, but it may not pop back up to where it was the weekend before Thanksgiving. But we did see a nice little pop of activity that happened right before Thanksgiving, where it jumped from 42% up to 46.3% odds of selling. But if you listed over this last weekend, based off of that weekend's market activity, it had a 36.7% odds of selling. The odds of selling, again, is where I take into account all of the available listings for sale versus those that go under contract and or close in the same week. Thanksgiving being such a shallow week for us in terms of what happens with pending transaction counts, the odds of selling really declines over those 3-day holiday weekends. Again, we don't want to list over these 3-day holiday weekends. Looking at where we should be for percent of balance based off of what went under contract last week, we would only need about 13,000 total available listings. So our percent of balance shot up to 49.6%. That number is going to come down again next week. We're probably down into this 35 to 40 range when we see what happens with this next weekend's worth of activities for those pending transaction counts. So don't get alarmed, but this is just what happens over these holiday weekends. And you can see it happened back here again last year in 2020, and it also happened again in 2021, where we ended up seeing that the odds of, or the percent of balance ends up going up over these 3-day holiday weekends. We always want to try and avoid those. Showing activity was really low this last week. Showings decline into Thanksgiving weekend by about 40%. And that was even 40% down from where we were 1 year ago, but there were only about 6,000 total showings that were set this last week. And it seems like I'm still only using showing time data.
Yeah.
Broker Bay is still not included in here, but Broker Bay, the more that I look at the pending transactions that are going under contract, I'm seeing fewer and fewer Broker Bay transactions. And so I'm curious if people are going back to using showing time instead of using Broker Bay, because I'm seeing even fewer where it's like 8 or 9% of the transactions are going through Broker Bay instead of the 10% that I was seeing earlier.
But how can you tell?
Just by scanning through and looking at the results page, I can see if
Okay.
it's a Broker Bay listing or a showing time listing. And so it seems like there's been a lot less of those transactions that are going through Broker Bay, and more of them are trending towards showing time. But this last week, you should have had 0.9, or we'll call it 1 show per property per week. So if you didn't get your 1 showing last week, it may be a first sign that you might need to make a price reduction over this next weekend. So that could be your strike 1. Again, I like to enlist that 3 strike rule. How many shows per week, how many showings to go under contract, and median days on market in order to make those price reductions. But it was about 0.9 showings per property per week at all price ranges. That was down by 35% from the previous week. We're looking at about 12 showings to go under contract this last week. It came in at 12.2 shows per property to go under contract. And so if you've had a total of 12 showings and no offers, that may be strike 3, where it's time for you to go through and make a price reduction at that point. Again, pending transactions really came down over Thanksgiving weekend. Total showings came really far down over this last weekend. It was a market decline of about 30 to 40% over these holiday weekends. Keep that in mind as we have Christmas approaching. If you have a property that you need to list and sell this year, get it to market as soon as you can, because the closer we get to Christmas, the more these numbers tend to deteriorate towards the end of the year. Median days on market this last week went up from 31 to 32 median days on market. So our days on market continues to stretch out, and I anticipate that number to continue to stretch out as we get into the lighter parts of December, as homes tend to sit on the market a little bit longer. So 32 median days on market. So if you've been on the market for 32 days, 12 showings, and you're not getting 1 showing per property per week, those are your 3 signs that you should probably be making a price reduction. Based off of what went under contract last week, we saw that 55% of all the pending transactions that went under contract last week made a price reduction, and that was down 2% from where we were the previous week. And so we don't like to see price reductions happen on these 3-day or 4-day holiday weekends, because again, what happens is that people don't have the showing bandwidth in order to gauge whether or not that showing was that price reduction was warranted. It doesn't give enough of those transactions, enough showings to really see if we're going to get enough properties, that property under contract. So this coming weekend would be a good weekend to do a price reduction rather than doing it over Thanksgiving weekend. The size of the price reduction, we're still seeing large price reductions at about 7.1%. Earlier, about a month ago, we were seeing a 7.9% price reduction. So we're seeing smaller price reductions at this point, but still a 7.1% price reduction means that you're taking about $43,000 off of the original asking price for an average priced home in Metro Denver, which hovers around $720,000 to $730,000 right now. We'll be going through and turning over the monthly reports on Sunday for you so that you get those updated numbers through the end of November. And I'm going to try and get those out to you by Tuesday, which is a tall order. So I've got about 48 hours to turn around about 200 pages worth of data for you guys so that you have this information headed into December. In the under $500,000 market, again, looking at what's been happening with our up to $500,000 market, the cooling trend really settled in, and you can see that we have our most blue row where we saw the least amount of market activity that happened over Thanksgiving week. In this market, we jumped from 1.3 months worth of inventory to 1.9 months worth of inventory. That number will come back down next week as we see a little pop of activity directly following Thanksgiving week. But 1.9 months worth of inventory, that was up 38.1% week over week. Our average daily active count came down by 4.9%, fewer new listings, down by 50% from the previous week. We only put 123 new listings on market this week. Expires and withdrawals were down, but we expect that number as I report through the end of November. Typically, I end up seeing a big purge of expired and withdrawn transactions, which helps drive down that active inventory line, which really tees us off for spring and what's going to happen as we get into those spring months. So these couple of days are really critical in terms of reporting reporting to measure those expired and withdrawn transactions. Pending transactions for the week of Thanksgiving were off by about 31.2%. So again, much slower market activity. The odds of selling dropped by 7.7% over Thanksgiving week. So not quite as much when we look at all of price ranges, but it was about a 47.6% odds of selling. And we had a pop of activity the week before where it jumped up to 55.3%. So we did see a big decline in the odds of selling as we went through this last week. We're sitting at 30.9% of balance. That number will come back down as we go through back into December. And so hopefully that pop of activity will carry us through, but we should have had about 6,000 available units for sale as we were looking at the numbers for this last weekend. 1.4 shows per property per week. So again, if you didn't have your 1.5 showings during the week of Thanksgiving, that could be sign number one that you need to make a price reduction. And we were looking at about 11 showings to go under contract. And so people are actually looking at fewer homes in these last couple of weeks than what we had seen in the previous couple of weeks, where they were looking at 14 or 15 properties before going under contract. So if you've had 11 showings and no offers, it may be time to make a price reduction. Median days on market for this week, they jumped up to 28 median days on market, which was up from the 23 that we saw just the week before. We saw that again, that little pop of activity driving down days on market the weekend before Thanksgiving. So hopefully we have that pop of activity again directly following Thanksgiving weekend. We saw that 52.7% of homes under $500,000 made price reductions, with 46.9% making no price reductions. Price decreases went up by about 1.5% just from the last week. The size of the price reduction, though, is large. It was an 8.4% price reduction, which is the largest we've seen for the last couple of weeks. We had another week a couple weeks ago where we saw an 8.4% decline in average sales price or price reduction. And so it was about a $38,000 price reduction off of the original price for homes up to $500,000 right now. And so those are pretty significant price reductions for homes under $500,000. For 500 to $1 million, which is really the meat of our market, this represents about 60.2% of our overall market. So this is where a lot of the transactions are going to fly, is in this $500 to $1 million segment. Cooling trend really settled in most blue row through the entire year, going into Thanksgiving weekend, indicating a really big cooling trend. We jumped from 2.3 months worth of inventory up to 3.6 months worth of inventory. Again, that number should be driven down going into this next week. Hopefully it comes back down to that 2.5 months worth of inventory range. But again, that just speaks to how much slower it gets over Thanksgiving week. Our average daily active count came down by 5.6%. New listings were down by 52.2%. So again, fewer new listings making their way to market as we get into December here. Pending transactions in this market were down by 40.8%. So again, not great to make price reductions going into Thanksgiving weekend, because you don't have the bandwidth or the number of buyers that are out there looking at homes trying to decide if they really want to make that purchase or not.
Plus, the buyers on that kind of weekend are going to offer low.
Yes, they
right?
are.
No
They're
matter
the bargain
what.
hunters. The
Right.
bargain hunters come out over Thanksgiving weekend and Christmas week.
No matter what it's listed.
Yes.
So if you lower it and then they
Yeah, and then they come in
It's-
and offer less than that. And so we end up seeing that they take bigger hits
Yeah.
if they go under contract over these holiday weekends.
Which is why that number was so deep.
Yes,
So New Year's Eve, are you going to see the same thing?
yes.
Okay.
Between Christmas and New Year's Eve, we're going to see a big
So you
decline
have
in
2
market
weekends
activity.
back to back.
2 weekends back
Yeah.
to back.
Okay.
And so we'll see when the market picks up this year. In the past couple of years, the market, it seems like January 2nd and the phone starts ringing and people want to go out and buy properties. I think with a higher interest rate environment, unless interest rates come down, I don't know that we're going to have that big kickoff to our spring and that huge spring run up like what we're accustomed to seeing, because affordability has taken such hits.
Mm.
And so it'll be interesting to see, but I'm anticipating that we're going to have negative year-over-year appreciation for the first 3 or 4 months of 2023, because we're not going to be able to hit those historic highs that we saw in 2022 when interest rates started to go up, and it acted as such a catalyst in our marketplace.
Big point there, right? It's comparisons.
Yes.
So that all the year over year in January, February, March is going to be related to January, February, March of
It's not a
2022,
fair comparison.
which were the hottest 3 months of the entire year.
Oh my gosh, the hottest 3 months we've ever seen in Denver.
Right.
And so it's comparing this year
So
to,
you can't
It's not going to be a fair
You
comparison.
can't relate those numbers to your clients, or at least you have to be able to explain what's really happening behind the numbers,
Yes.
right?
Yeah.
But
And
the
so
news won't do that.
no, the news won't do that. So be prepared for that. And it's
Mhm.
as I go through and as I get towards the end of the year, I have to go through and set up my projections for 2023.
Yeah.
And I think I'm going to remove all of the COVID years, 2020, 2021, and 2022,
Yeah.
because they were such exceptional years in real estate that I don't think that they compare. And we're going to go back to our normal seasonal cycle of 2013 through 2019. So I think I'm going to remove the COVID years
Mhm.
when I put together my benchmarks for 2023. I just don't think that we're going to hit those historic highs again.
So starting in your reports in January, then will you have all of this lined data for 2020, 2021, or will you actually remove it?
No,
butt it
I'm
up
going to
against-
I'm going to keep this report the same, and I'm going to
Okay.
keep reporting on a weekly basis just because I've already started
Yeah.
doing that, and I can't go back through and recalibrate it, but it's going to be this,
forecasting.
yeah, but with the forecasting
Okay.
reports and the attached and the detached reports, I think I'm going to rely heavily on 2013 through 2019.
Makes a lot of sense.
Yeah, it just doesn't make sense to include those COVID years anymore. Odds of selling for 500 to $1 million dropped down to 33.2% over this last week. The previous week, it jumped up to 44.1%. So we ended up seeing that there was that nice pop of activity the weekend before Thanksgiving. We'll see if there's the nice pop of activity directly following, since everyone took a week off in Metro Denver. We ended up trending towards 60% of a balanced market. Previous to that, we were at 37.6% of a balanced market. So I think that we're going to pop back down to that 38 to 40% of a balanced market range. And so we would need to have about 6,000 units available for sale in this market to get to a market in balance. We saw about 0.8 shows per property per week. So we could call that maybe one last week. If you didn't get one, don't freak out. Again, there's more inventory in this market, and people really took Thanksgiving week off this year to spend time with family. We were looking at 12 showings to go under contract, which is down from the 14.5 that people were looking at just a couple of weeks ago. So people are making decisions a little bit more quickly in light of having less inventory to look at and getting something under contract before the end of the year. But they looked at on average 12 showings to go under contract. So 12 showings, no offers, probably time to make a price reduction. We were looking at 39 median days on market in this price range. And so look at how much median days on market has grown in this price range. We were hovering at 4 up until about Easter weekend when it started to shift and shake. And now we're looking at 39 median days on market. So if you've been on the market for 39 median days and you haven't had an offer, it may be time to make that price reduction at that point. What went under contract last week, 60.1% of them made price reductions, with an average price reduction of about 6.3%, or about $45,000 off of their original asking price. 1 million to 1.5 million, again, cooling trend really settled in as we got into Thanksgiving week. Rows keep turning more and more blue as we get deeper into the year. We went from 2.9 months worth of inventory up to 5.2 months worth of inventory. So again, big weekend for buyers to get under contract and have extreme negotiating power in this $1 to $1.5 million market. Our average daily active count came down by about 4%. Pending transactions were down 45.9%. So again, this is due to a lack of buyer activity over this weekend that this number shot up so much, because our active inventory is trailing down. New listings were down by about 73% this last week. So again, a lot less new transactions making their way to market over Thanksgiving weekend. The odds of selling dropped from 40% the week before Thanksgiving down to 27.5% odds of selling. So again, hoping to see that pop of activity the weekend directly following, but that was down by 12.5% if you listed a home over Thanksgiving weekend. We popped up to 58.2% of a balanced market. That number will come back down as we get into the first weekend of December. We were hovering around that 32.7% mark the week prior to Thanksgiving. So hopefully we come back down to that 33 to 35% range as we get into the next part of December. We only saw about 0.7 shows per property per week. Showings were off by 41% this last week going into Thanksgiving weekend. And so if they're looking at about 15 properties before going under contracts. We've had a total of 15 showings and no offers. Maybe time to make a price reduction. In this market, we're still looking at 21.5 median days on market. So that's significantly lower than what we're seeing in the $500 to $1 million segment. When I start to break out cash transactions over $1 million, they're less sensitive as to what happens with interest rates. It's about 40% of people buying homes over $1 million are using cash to make these transactions happen. And so they're not focusing as much as what's happening with interest rates. And so this market is actually a little bit hotter than what we're seeing at the lower end of the price spectrum under $1 million. Only 30% made price reductions this last week. 70% made no change. Average price reduction this last week was only 5%. And it was about a $66,000 price reduction going into the $1.5 to $2 million range. For $1.5 to $2 million, looking at the cooling trends settling in, again, the most blue row that we've had so far, signaling the least amount of market activity this last week. Interestingly enough, predicted month supply of inventory went down this last week over Thanksgiving week, which is kind of an anomaly. And so pending transactions this last week were actually up by 43% in the $1.5 to $2 million range. So this market actually had a pop of activity that happened. Average daily active count, we only had 192. That was down by 1.5%, but we put more units under contract, driving our month supply of inventory down. Hopefully another pop of activity will happen again this weekend, driving that number down a little bit more, but 4.4 months worth of inventory is not that shabby, looking at the $1.5 to $2 million range. The odds of selling did decline by about 7% this last week, down to 20.6% if you put up a new listing this last week. The week before that, we were measuring at about 27.6%. So I'm hoping to pop back up to that 25 to 27% range as we look at this pop of activity going into next weekend. Looking at where we were for percent of balance, we only have 36.8% of balance in this particular market. We were getting about half a showing per property per week in this particular market. So again, not a ton of showings that were happening. Showings were off in this price range by about 30% from just the previous week. Looking at shows to contracts, we were at 11.9, or we'll call it 12 shows to go under contract. So if you've had a total of 12 showings and no offers, it may be time to make a price reduction. 25 median days on market. So if you're sitting at 25 average days on market, that might be your signal to go through and make a price reduction at that point. Only 33% of the homes that went under contract last week had a price reduction, and the average price reduction was smaller at about 4.8% or $92,000 off of their original asking price. And so overall, that market that's in that $1.5 to $2 million range is actually still thriving compared to what we're looking at for lower end price points. And there's this really interesting pool of potential buyers that are sitting out there that are over 1.5 million right now, that are just waiting for that perfect home to come onto the market. And they're getting snapped up very quickly if they're in a central Denver neighborhood location. They're show well, they have great curb appeal. Maybe they're offering some sellers concessions, but that market is actually doing very well. It's our $500 to $1 million segment that's really dependent on what happens with interest rates, that's lagging behind right now.
And so what's interesting is the core logic appreciation, which includes jumbos, but the FHFA, which doesn't, the core logic's actually showing a greater slowdown than FHFA. So nationally, they're talking about the fact that the jumbos are seeing less activity, really, these higher price points. And here we're seeing, and then of course, I'm going to show a couple news articles. They're talking about, Denver is kind of leading the charge with some of the price reductions that we're seeing, certainly some of the slowdown in transactions. I mean, all in all, we're kind of a unique, I don't want to say we're a unicorn metro. We're certainly not that, but understanding how it relates to the national news, to the local news is also important. Yes. Because you're clearly seeing that there is a lot of activity at that price point, whereas nationally, they're not seeing that kind of activity, which I think is zeroing in on those expensive markets where really somebody who has that money, I hate to say this, they're less affected by the recession. Their jobs are doing well. Maybe they're even making more income, and they're not interest rate dependent. So they might be in a position where that increase doesn't affect them as much, or they don't care as much, and they're going to buy it anyway.
We had one question pop up, and it said that there was one red square amongst all the blue in the heat map. And so that was actually new listings coming to market. And so it's better to be a seller in the market when you have less competition in the marketplace. And so that was new listings coming up in that particular week. So again, that cell turns red. Hi there. Thank you for all the amazing data and information. 22 median days on market for the market between 1 to 1.5 million, and 25 median days on market for 1.5 to 2 million. Seems very fast when the odds of selling are going down so much. What is the average days on market? I don't track the average days on market on a weekly basis, but on a monthly basis, it's about 30 based off of data from October. And I'll have updated numbers for that for you by about Tuesday next week, so that you guys have that information going into December for that particular market. So I track the median, which is the point at which half of the listings are under contract rather than the average, because it can get so skewed.
All right. So we ready?
Yeah,
Get in the second half.
let's do this. Are we right at 10:30?
We are right at 10:30.
Awesome.
Yeah, it was like magic.
Mhm.
So we're going to talk a little bit about what's happening. We're going to start out with some news articles. We're going to talk about interest rates. Guys, this is the opportunity to communicate with your buyers that if they're afraid, then we don't want to push them further into fear. We want to support them into a purchase in 2023. But if they're ready, and if the numbers work, and if they're looking for opportunity, this weekend might show them some of that, where we might see some of the sellers doing a price reduction because it didn't sell last weekend, right? And if we did see a nice drop in interest rates, could they get into a home that they've been wanting for even before Christmas? We're still closing in 8 days. Guys, we have weeks still where we can close before Christmas. So this is something where we can be talking about the fact of getting into a home for the holidays, getting in before the tax year changes, taking advantage of tax benefits if that's relevant to you in your financial situation. Like all the things, the conversations that can be had this time of year is not the time of year to bury your head, but get super strategic on how you want to create the pipeline for the spring, because the spring's going to be interesting all by itself.
It is.
It is. All right. So let's share screen. We're going to go through some of the things. All right. So I'm going to make sure. Yeah. So don't spend time beating your head on the wall. So I just had to show the visual for that because I just so love Coco Chanel. So we are in December. I don't know how that happened. The year is almost over and I am ready. Like I am ready to go, bye, Felicia. Like, let's just put 2022 behind us. It was certainly an interesting year. 2023 will be as interesting, right? And if you love when markets shift, you're going to love this next year because you're going to have the opportunity to shine. You're going to have the opportunity to communicate and educate because there is a lot that's going to happen between the Fed and between interest rates and inflation and home prices and the swell of demand coming back on the market, and being able to have your finger on the pulse of that and be able to communicate it so that it makes sense and isn't irrational, because irrational creates fear. And the one thing that you want for your clients is without fear. You want them to be able to go into the transaction feeling good about it. But really quickly, a highlight, and I know you've got some good news on an event you're going to be having in the spring as well. Yes, that we're going to be working together on again. I love these. But the first one, and then we need to have you do a teaser on the second one.
I know I've got a bunch of stuff to get set up for it. So it's just a very just opening teaser.
Early teaser. But this teaser is coming up really quickly. And you guys have been hearing about the next big thing. But I want to highlight, because we've been talking about some of the bigger name, maybe more motivational speakers. We also have some very deep content speakers coming for this year's one day next big thing, downtown Denver. The price of the ticket includes parking, valet. So make sure to get there early. You don't want to be stuck on that valet line, but it includes the space, the parking, food, lunch, the workbook, all the things. And guys, this isn't a profit-making event. In fact, all profits go to Project ICU, which supports women, single women, many of them moms, getting into home ownership for the first time. All the profits go to that. I don't do it for the money. I do it for the love. And I know you do too, for the passion in bringing together such a high caliber of professional speakers. And guys, if we sell enough tickets, like I'll start giving sponsor tickets away or create sponsorships. Because I want more people to come. And if you're a newer agent and you can't do it yet, shoot me an email. Let's get you on a list. If we sell enough tickets, let's start creating scholarships. I said sponsorships. Let's start creating scholarships for more people to come, because that's the goal of this, to get around high energy agents all looking towards 2023. These guys, Lee Brown, phenomenal. She's got a podcast. Crazy Shit in Real Estate. If you haven't signed up for that one, make sure to subscribe. Marky Lemons, realtor, educator, phenomenal woman who has quickly changed careers several times based on the changing market, and the way she pivots and the way she educates. She's helping people now primarily with social media, but her perspective is intense, and they're both deeply rooted, successful real estate agents.
I'm so excited for this event. It's going to be
so
great.
much content. So what's your give a teaser?
Oh, so we have an entire team of data scientists that work at First American Title, and we just did a national webinar with about 6,000 agents on it with Mark Fleming, who is our national chief economist. And so he's actually going to be flying out because I won a competition for getting the most number of people to go to the webinar. So he said that he would come out to Colorado and give us his perspective in May about what's happening across Metro Denver as we get through Q1 and get some of those projections lined out for next year. And so I'll have him out in May at some point. So more information to come on that. We're just getting the first steps lined out on that one.
So really just stay in the loop as far as all the education that we're going to be having. We'll also have several other agent ignites that we'll be putting together with other speakers. So all the things. And then of course, finishing the year with our goal setting like we just had in November, which was just fantastic. All right. Here was the first news article. There was two really big ones that I had several agents emailing me going, what are your thoughts on this? So this one puts Denver kind of at the top. Phoenix and Denver, they're leading the charge. We're seeing that they're descending back to earth. Interestingly enough, when you read the article, they're not necessarily talking about home prices dropping substantially. They're talking about sales. They're talking about our sales numbers, which we've seen. Our sales numbers have come down. They're also talking about softening prices. So we're not seeing this. We're seeing a deceleration of home prices. We're not yet seeing negative home prices. So this is really important to get further into these articles and reading them. And they're talking about transactions being down another 20%. And that wouldn't surprise me at all based on what we're seeing in the numbers. And then going into January and February, depending on what rates do, we might see a quiet winter before we see a really big pickup in spring. It really does depend on rates. So we'll keep talking about that. The next one is buckle up for a brutal free fall. So this one had several housing experts, not even economists, several housing experts stand up and talk about what they think is going to happen and this housing bubble that's going to bust. Now, a lot of it talked about the fact of units sold, but they did go on to talk about the fact that they see 15 to 20% decline in home values. If we see that, remember when we showed the Black Knight report showing a 5% decline, a 10% decline, and a 15% decline, how many homes actually go into negative equity? The trick with real estate, or the secret, if you will, is don't sell, right? Don't sell. Real estate is long-term. And I'm going to show you one of those charts in a minute. The home prices always go up, even when they decline. Yes, it takes several years to get back to that position. And I get that. And especially if you need to sell during those down years, that's a loss. That's a real loss. But if you can hold on to that property, and especially if it's locked in the 2s and 3s and convert it into a rental and earn income on that property while it regains its home value and then continues to appreciate, the odds are stacked in your favor to continue to have this real estate investment support your financial stability and long-term wealth creation. I mean, real estate is more than a home. We have to communicate it in a way that it's wealth, right? And you have to think strategically, not out of fear, but out of strategic action. So the negative equity, if we do see it, and it could happen, especially nationwide, 5%, 10%, 15%, we're still only talking about less than a 4% hit to the people who own homes, who have mortgages, going into a territory of negative equity. Everybody else will still be able to sell, should they have to sell, for a profit. And then what that is unrealized gains. It's the fact that you lost some of the big wins that we had over the last 2 years, and you gave it back. And maybe over the course of the longer period of time, you ended up at the historic average of 3.6% appreciation, which is still really fantastic for gaining, considering you put 3, 5, 10% down. The question your clients are asking right now with the headlines that we're seeing that are bold on fear, right? Highlighting that emotion is this investment or is this home a good one? Is this a good investment for me and my family and for my long term? That's what they need to hear from you. You need to be able to break that down for them. So I went into Fred and I picked up some of their charts for the Denver Metro specifically, right? So you can do this for all of the United States, which a lot of those numbers are being also highlighted in the news. But I picked out Denver Metro to talk about what is it that we're really seeing. And we are seeing a deceleration. Like, I can't hide that. That's real. We are seeing that, but we've seen that kind of deceleration before. It's just from a bigger number. So to see 60% depreciation or a deceleration, so not depreciation, a deceleration from the very top. We saw that in 2008 to 2019, and we saw something very similar, a little less, 2014 to 2015. Now, I don't know about you, but I had a great 2019.
Yes.
And I have 24 doors and 2 commercial buildings, and I did really well on those too. Because here locally, we saw a small, very small single digit, in fact, hovering around 2% of median price growth that year. But we continued to gain and continue to sustain the opportunity to continue to build that kind of wealth. So 60% deceleration, that's a big deal, which ties exactly to the interest rates rising. So that it's not a surprise. We kind of should have expected this. So with the interest rates rise, we see home prices slow down and home price acceleration decelerate, but long run, we're continuing to gain in value. So this is the home price index, again, for the Denver Metro. And if I go back from 2012 and right before this, it took us about 5 years to clear the loss that we had from 2005 at the height to 2008 and 9, and then coming out and getting towards the bottom and flattening out in 2011 and 12. And as we start to pull out of that cycle and we move into this next cycle, if you had listened to the news and operated in fear and not bought into the market, you would have lost this opportunity for 151% gain. And that's including the downturn. And so we're still going to see more deceleration, right?
Yes.
We're going to see October, November numbers come out because these are October. November numbers come out, December numbers come out, probably January numbers come out, probably February numbers come out, and probably even March numbers come out before we start to regain our home values as buyers come back on the market. When the interest rates drop, you have all this pent-up demand. Remember, the largest age today is age 31. And as those 31-year-olds and all those people who were first priced out, then feared out, now coming back into the market, they're going to be coming right back in when everybody else is coming back in. And now they're going to be bidding up on home prices again. Meanwhile, they could get all the things that we've been talking about. They could get a discount on the purchase price. They could get all the home inspection items repaired, and they can get a seller credit that could buy down their interest rate or pay all their closing costs or reduce their cash to close. And then they can refinance when that happens. But based on what the rates are doing today, you pay for, instead of doing a temporary buy down, do a permanent buy down and just get into that mid 5s right out from the very beginning and never refinance. You just supported your client, settled them in, and they're taken care of. And now, instead of dealing with a refinance next year, they can be looking towards their next purchase opportunity in the continuation of building wealth. So we're up 151%. If you put 10% down, that's a 1,151 gain on your investment. I mean, this is the kind of opportunity you don't want to keep missing over and over and over again because you're in fear. So we're still up. We were up 44%. We're still up 38% from the pandemic. And then we're down 4.7. So we'll continue to watch this as S&P Case-Shiller continues to put out their home appreciation, but this is appreciation. This is not average and it's not median price changes. This is actually that pinpoint of that home and what that home's price value is changing based on its turnover and based on the comps in the area. Lawrence Yuna had said this, housing recession is here because of the reduced income from brokerage services and mortgage lending and the fall in home construction. It's this job cuts, reduction of income, which is a reduction of spending, and then all the things that go with the home, the spending on the home, the purchasing the home, the fixing up of the home. It's an entire industry that affects the GDP. Nowhere in there did he say that housing recession was tied to the price of the home? Right? We're talking about the volumes going down and the reduction of, yes, maybe you're not making as much because of the transactions are down. The lenders are not making as much. The builders are slowing down, all of those things. We were first to go in. And it started back in April, especially for those lenders who were highly focused on refinances. And then we'll be the first to come out because we're so heavily dependent on interest rates. And as those interest rates drop, because inflation will drop as we go into the recession, then we'll see more activity and push those prices back up again. The housing inventory is a quarter of what it was in 2008. Distressed properties are almost non-existent, only 2%, and nowhere near the 30% mark we saw during the housing crash. This continued conversation around busting the bubble boys, right? Being able to communicate against the housing bubble and this expected crash, right? Around the fact that yes, volume is down, right? Because demand is down.
Even so at the peak of our market back in 2010, 52% of all of our transactions were distressed. Based off of data from last month, we had 1 out of 3,000 total closings that happened in the month of October that was a distressed transaction. We are too flush with equity.
Yes.
Our job market is too stable. And so we're not going to have that dual trigger effect that creates this market where we're going to have this big recession or this big loss in home value. This is a correction due to affordability and not due to the economy.
And an egregious increase, 44% over 2 years.
Yes.
So yeah, we might have to give some of it back. If you sold at the very top, good for you. Like really fantastic. You timed it perfectly. But I will tell you that the continued hold of those properties, I didn't sell a single thing. I didn't sell a single thing because I'm not in it. People don't day trade homes. Right? So if you transferred into another home, unless you were done owning homes, you bought another home at the height of the market at the same time.
Yes.
So it was typically home sellers are home buyers. Existing home inventory, just to show it visually, he was talking about it. We are 30% of what we were in 2006 as a country. Here, we're equally as low. I mean, to see the numbers that you were showing up there as far as what we have in inventory, it's nowhere near hitting any kind of balanced market.
No.
But it feels like a buyer's market because buyers have opportunities that they haven't had in years, and they need to take advantage of it because that won't be around the second half of next year.
It's like we've gone from driving 120 miles an hour to driving the speed limit.
Yes.
It's all comparative. Slow. It feels so slow, but in fact, the market is still very good and it still favors the seller, but it's such a different market than what we've experienced for the last 3 years.
So housing starts are also not what they were leading up to the last housing crash. So you're seeing this pullback already. You're seeing a pullback in housing starts. You're seeing a pullback in housing permits. Builders are waiting. Builders don't love the high interest rates any more than the buyers do because they know that they might lose those buyers who are under contract since they can't get locked in given the long construction times. So they're just working through their construction pipelines. They're not starting a whole lot. In fact, the single family housing starts were down 22% year over year. This is going to continue to put pressure on inventory, not allowing us to be flush with inventory like we were during the last housing crash. So just yet another piece of the argument. Housing equity. So putting the two pieces together. So Fred doesn't have this as specifically as a chart, but I merged a couple of charts that Fred has. So showing the total value, so that's this blue line of homes. And then the red line is the mortgage debt that's outstanding. So you continue to see the value of homes, even as it dips. So as the value of the homes stays up high, we have this incredibly strong amount of equity, which also adds in the fact that we have almost 40% of all homes that don't even have a mortgage, which is why we have 71% equity in our homes, which is the very thing that's going to keep this housing market stable.
Yes.
Bouncing around a little bit, right? I mean, we're bouncing around. We're seeing the cycle. It is coming down. We're seeing the lower volumes. Some sellers are having to pull some of that unrealized gains off the table in order to sell their home. All of those things are true. But the longevity of the housing market is in the strength of the equity as well as the strength of the buyer in putting this together where we're seeing jobs continue, we're seeing wages continue to increase, we're seeing the stability of the homes continue to have cash, and now seeing this kind of equity continue to sustain. It's not anywhere near what it was in 2008 and 6. And in fact, we see 59% equity in 2005, and it dropped to 46% equity, very different from 71% equity. Adam put out a report talking about the equity keeps growing. Just even looking at, they were looking at homes only that had mortgages. So those homes that had mortgages, almost 50% of them have more than 50% equity. So again, we just looked at the fact that all homes, including the ones that are owned outright, have 71% equity. Now the ones that have mortgages just continuing to stabilize all of those homes against any risk of foreclosure and delinquency. So this continues to be strong. Another one of the facts that we just continue to double click on is the fact that 86% of all of the homes are locked in under 5% that have a mortgage. So they're going to be slower to put their house in the market. They're going to hold on to those homes, keeping inventory off. They have a very stable low mortgage payment, which is going to protect them against any continued rocking what we see in the first quarter, right? And so all that continues. It's that constant conversation around the strength of the housing market. So I put together a blog on Saturday morning. I don't know how many people read it because it was Thanksgiving, but it was Saturday, and that's what I do on Saturdays.
Yes.
I was like, I am a creature of habit. So on Saturday morning, I put together a blog, and it was 13 reasons why the housing market remains strong. So this was a handful of them. The rest are in there. If you want to go to our website and look at the blog and grab the rest of them, certainly feel free. With these pictures and that information, the continued conversation around, here's the statistics around the strength. Now, if it makes sense for you and you're financially able and you like to take advantage of opportunities in investments or in real estate, this is the market for you. So we did the little dance, and that was 3 weeks ago. And so 3 weeks ago, we saw the CPI numbers come out that gave us an incredible day of lower interest rates. In fact, I know social media was flooded with a whole bunch of lenders talking about how low their interest rates are. CPI didn't come out today, but PCE did. And so we are seeing a similar drop. In fact, this was from the Fed meeting yesterday, or I should say Powell's speech. It wasn't a meeting. Powell's speech yesterday, and then this is back from the 10th when the CPI numbers came out, but we're actually right below 3.6%. So this number had crossed over 4. This is the 10-year Treasury yield, and the 10-year Treasury yield had crossed over 4, and that's when everybody was like, oh no, the interest rates are going up, and they did. Right. And they've been slowly coming back down again. So we saw a nice little drop. I love that.
We like to see this. This is what makes us happy.
Oh, I was like, yay, look at how big that is. So we've been stable. Now, is this a trend? No, I am not going to call it a trend yet. I'm going to call it an opportunity. I'm going to call it the fact that take advantage of these opportunities when you've got a weekend like right now after a holiday where maybe there's some trailing inventory where the sellers are willing to reduce the price, and you've got some buyers that's sitting on the sidelines, and you can still close in 8 days and get them into the home before the holidays and lock them in. I was looking at interest rates. I mean, we're at 6.25 with no points, and you could drop down to 5.75 with a point, or 5.875. I mean, if I could get into, or even if a seller was willing to pay for discount points, get it into 5.5, you literally might never refinance, because that's really where I think interest rates are going to settle in, is in the mid 5s.
Yes. That I would be very pleased with a 5.5% interest rate.
Agreed. That would create a stable market where people just wouldn't be buying homes just to buy homes like they were when they were 2.6, right? That was unhealthy. We don't want that. But 5.5 is where people who are able to move, can afford to move, are moving and taking advantage of a 5.5 versus a 2.5, 2.75. They're just doing it just to do it. That's what created some of this. So Powell's conversation yesterday, it was not like super exciting, but it was a little bit of a, okay, maybe we do need to let the economics catch up with what we've been doing with the Fed rate. So he pretty much laid out, and people assume based on his conversations, although he didn't say this specifically, is you can expect a 50% increase in December, a 50 BIP increase in December, a 50 BIP increase in February, and a 25 BIP increase in March. and then hold. Right? Because there was some conversations with some of the Fed board members talking about the fact that we needed 6% Fed rate or a 7% Fed rate. So he's going back to that, 5.25. Let's get there and let's hold. Maybe even, and he hinted to the fact that we might even see some Fed rate reductions in the second half of the year. So if we do that, that would mean that inflation will finally I don't know if it's going to happen that fast, but if we can get inflation under some sort of control, and he even said that in the meeting or in the presentation yesterday, where he did confirm that the smaller interest rate increases is likely, yet we have not fully engulfed inflation. We haven't dropped it down fully. It's still inadequate as far as what we've done to it, but we need to let the economy or the economics catch up with the Fed rate increases. So here's some economic news. I'm going to throw through these pretty quickly because this is a little bit of the confusion, but I'm going to highlight, based on the information, why the market gave us a little bit of a benefit today. So continued jobless claims actually went down 16,000. So that's not good for interest rates. That would actually make interest rates go up because that means that people aren't filing for unemployment, which means they aren't losing their jobs. Yet continued claims actually jumped up. So those who are on unemployment, who don't quickly get another job, are staying on unemployment, whether they want to, whether they don't want to, whatever that situation is if you entered into unemployment, you're staying there, but those who are being laid off are quickly finding new jobs. So the continued claims wasn't good for us, but the jobless claims was not good for us, but the continued claims was. Then we had the JOLTS report also came out this week, and that came down slightly. So remember, it was at 10.7 last time, and now it's at 10.3. So that job openings is still saying that those people who are laid off are finding new jobs. They're just finding a little fewer of them. So this is something that we do want to see. We want to continue to see the job openings decline. We want to see jobless claims increase. We want to see the continued jobs continuing to increase. I hate to say that. We need to see job loss. We need to see the unemployment number going up to 4.4. That's going to be the thing that controls spending. And that's going to be the very thing that allows the Fed to not only stop raising the Fed rate, but then to start dropping it. ADP came back down. So we expected 190,000 jobs to be created. We only got 127,000. So that's still positive, but it was not as good as expected. That's one of the things that helped us. So the ADP numbers is just showing that it is a slowdown of new people getting hired. So all of these things coming together is talking about the fact that we need jobs to be lost so that we get spending to come down, so that the GDP slows down, so that inflation slows down, right? Then interest rates can come down. All of this is literally math. And so I explained it, and I'm not going to go into it any more detail. But we put out a YouTube video this Wednesday that got blasted out via email. You can also subscribe to our YouTube channel, exactly how this all works and how recession helps housing, specifically around those interest rates. PMI manufacturing just came out this morning. So it actually entered into a contraction period of time. So now we're under 50. Over 50 is expansion, under 50 is contraction. But the one thing that was really good is prices came down and they're coming down faster. Core PCE came in slightly less than expected. So that again is helping us with interest rates today. So all of this we're going to continue to watch through the end of the year. But what I would tell you is to start focusing on next year. How are you communicating with your buyers right now? That's one of the things, again, on the YouTube channel that we put out on Tuesday, 3 ways that you can start communicating with your clients now to prepare them for 2023. Because I'm certainly not going to try and convince somebody to buy, but the opportunity to buy for somebody who is looking for those kind of discounts is getting them, right? So start preparing for 2023. And then the best part about that is you can prepare with a higher income limit or a higher loan limit. So 726 is the new 2023 conforming loan limit, and we're locking in loans right away with that. And then, so it starts officially January 1st, but we're going ahead and locking people in right now. So that's just going to give more access, right?
Yes. Well, and less of a barrier for entry for those first-time home buyers. Our first-time home buyers have been so impacted by affordability. This is so great because they're able to put significantly less down at a higher rate and get into a home here in Metro Denver.
Love it. So here's where I'm going to land. It doesn't get easier. This economy is going to continue to be confusing to many this next year. You continue to get stronger, continue to educate, continue to share what you learn, continue to help your clients get into home ownership. That's how, as an industry, we get stronger. I think we had a couple questions, but I know it's 11 o'clock.
So let's go through and we'll scream through these questions really quick. Can you please explain the odds of selling again? Yes, it's basically where I take into account all of the available listings for sale versus those that go under contract and or close in the same week. And it's projected forward for a 30-week or a 4.5 week period of time to cover the month for what the odds of selling. I do have data. So the next question is, do you have any data for 2 million and above? I do in the monthly report, but not in the weekly report. There are only like 2 or 3 transactions that are happening every week that are over $2 million. So I'm not seeing
and
that.
That's coming out on Tuesday.
And that's coming out on Tuesday. Yeah, I'm committing to that. I'm now that I've said it out loud, I'm committing to that. Like I've got to work on Sunday and on Monday. I've got to get all of that done. What am I seeing in the foothills? The foothills communities are really on fire right now. Evergreen and conifer specifically, golden, conifer, evergreen, and pine are doing really well. And when I look at my heat maps that are in the attached and detached residential reports, those markets are just still really rocking and rolling. It was something like 47% of those transactions were still selling for over asking price. And so
doesn't surprise me.
No. And so at the foothills communities, typically inventory drops off as we get into the winter months, but the buyer activity, the buyer demand starts to go up because people are seeing all of the pretty snow and they want to get into a mountain house. And so we end up seeing those markets really take off in the winter. Laura Levy said, today is such a great day to be a buyer. I started calling all of my buyers and brokers who showed my listings and claimed buyers couldn't afford list price based on higher interest rates today. They can afford the asking price. So
they
yes,
need to call me.
Call Nicole. So just a couple of good jobs in here pertaining to the real estate being a great long-term investment. What about pockets of town where there's tremendous growth, multiple cranes putting up multiple high rises? Do you still think the value of one's high-rise condo will still increase? I think that we're having some challenges in Lodo right now. In Lodo specifically, where it's 99% of those are attached residential condo dwellings. We have 9 months of inventory right now. So that market has transitioned into a buyer's market. It's truly the only buyer's market that we have here in Metro Denver. And so it might not be a great long-term investment. I would say look out into the inner landlocked ring suburbs right now for some of those areas of higher appreciation. I'll give you a little tip. I like to invest in Lakewood because they recently put a growth cap initiative into place. And so that means that it's going to be further insulated from that new construction, holding those home values a little bit better. Is the equity graph national correct?
Yes, the equity graph is national. You'd have to go, Fred is not going to show you the local. We could go to a couple of different Colorado specific sites to try to piece it together. It's a little bit harder.
Can you quote a conservative investment rate on a triplex?
I am not going to do that online, but I can call you later, Angelina, and tell you.
Yeah, we'll follow up with you.
Yes.
And so just a couple of thank yous. And so for foothills and NoCo, not as busy as southern communities. And so again, I only track and trend what's happening in Metro Denver. I don't have the data to support what's happening in Iris or down in Colorado Springs. Maybe sometime in the future, in all of my spare time, I will put together those reports for you and maybe have those available to you next year if I can get a grip on my reporting, because it's out of control right now.
You guys, it's been great. This is the time of year, and it's the kind of economy where we just have to continue to step up our game, continue to educate ourselves, continue to be beacons of light for our buyers and our sellers. And I've just enjoyed putting this information together. I know Megan has as well. If there's anything that we can do to serve you and your clients so that you've got a consistent voice behind your desire to support them in building financial wealth and stability through home ownership, we would love to continue to serve you and your clients and see them at the closing table. Nicole Ruth with the Ruth team at One Trust Home Loans.
And Megan Eller at First American Title.
Yes, it's a pleasure.
Thank
Happy
you
Thursday.
guys. Have a good one. Bye. There it is.